Hello, my name is Troy Adkins, and I am the founder and owner of Adkins Capital Management. Adkins Capital Management is a housing advisory services company. I want to talk to you today about the key events that have transpired in the U.S. residential housing market during the second quarter of 2023. During the second quarter of this year, a review of the State of the Nation's Housing Report by the Joint Center for Housing Studies of Harvard University and a review of the monetary policy actions of the Federal Reserve to help curtail the impact of inflation on the U.S. economy were the primary topics of conversation. This movie presentation also provides an overview of the home price level for a select group of cities that make up the Adkins 60 City Home Price Index, and it provides a wealth of information for prospective homebuyers to use in order to make a prudent home purchase decision. This presentation was written, narrated, edited, produced, and published by Troy Adkins. I am the founder and owner of Adkins Capital Management. Adkins Capital Management is a privately owned and independently operated company. Our exclusive focus is on residential real estate. ACM is not affiliated with any parties associated with the residential housing industry. Our mission is to bridge the gap in the residential housing market, where deficiencies in education, public policy, regulation, product structure, and personnel have created an environment where prospective homebuyers need objective information and useful analytical tools in order to help them make a prudent home purchase decision. As an investment professional, I have more than 15 years of real estate analysis experience, more than 10 years of institutional investment consulting experience, and more than 8 years of freelance financial writing experience. I am also the author of more than 25 published articles. For more information about my background, skills, and experience, please visit the Adkins Capital Management website. With this overview of Adkins Capital Management in mind, let me now turn your attention to our analysis of the State of the Nation's Housing Report by the Joint Center for Housing Studies of Harvard University. In terms of home ownership, the premise of this study is based on the fact that home equity levels hit new highs, while delinquency and foreclosure rates remained low during 2022. In 2022, the total number of homeowner households was approximately 85 million. The national home ownership rate was 65.8%, and the number of U.S. households grew by 1.6 million. According to the Federal Reserve, homeowner equity in the U.S. totaled $31 trillion in the fourth quarter of 2022, up 33% or $7.7 trillion in real terms since the start of the pandemic. Despite declining home prices due to rising interest rates, aggregate equity remains up $3.5 trillion year over year nominally and is nearly 2.5 times the aggregate mortgage debt level. The average homeowner had $270,000 in equity in their home as of the fourth quarter of 2022. Moreover, many homeowners thrived in 2022, with home equity levels hitting new highs and delinquency and foreclosure rates remaining low. According to the JCHS report, as long as interest rates remain elevated, home price growth will likely continue to slow. However, prices are unlikely to plummet like they did during the Great Recession, thanks to the combination of the strong job market, the continued aging of millennials into peak home buying years, the dearth of housing available for purchase, and the low foreclosure rate. In terms of housing cost implications, the premise of the JCHS study is based on the fact that there are more than 19 million cost-burdened homeowners in the U.S. The housing cost burden, which is defined as the number of homeowners spending more than 30% of their income on housing costs, is increasing at an alarming rate. Between 2019 and 2021, the number of cost-burdened homeowners jumped by 2.3 million households, the largest increase since the height of the housing boom in 2005 through 2007. As a result, 19 million homeowner households, or 22.7%, were burdened by monthly housing costs in 2021. Of the 19 million cost-burdened households, 8.7 million, which is 10.4% of all homeowners, had housing costs that exceeded 50% of their income. Homeowners with low incomes were only one of the many vulnerable populations whose burden rates increased between 2019 and 2021. Cost burdens affected a quarter of all homeowners aged 65 and over, which is 26%, more than a third of all single-person homeowners, which is 39%, and 36% of single-parent homeowner households. In terms of housing sales, the premise of the JCHS study is based on the fact that rising interest rates hastened home sales in 2022. Higher interest rates have pushed homeownership out of reach for millions of potential homebuyers at a time when large numbers of millennial households are at prime home buying ages. According to the FHFA National Mortgage Database, nearly 2/3 of outstanding residential mortgages carry an interest rate of less than 4%, including 1/4 of mortgages with interest rates below 3%, which is significantly lower than the 6.75% average on a 30-year fixed-rate mortgage at the end of 2022. In 2022, only 641,000 new homes sold, down 17% from the year prior and well below the pandemic peak of 822,000 in 2020. The median sales price for newly built single-family homes was $457,800. Existing home sales dropped 18% in 2022 to 5 million, including a 17% decline in single-family home sales to 4.5 million and a 23% decline in condo and co-op sales to 546,000 units. Seasonally adjusted existing home sales declined just 4% in the first quarter of 2022 relative to the first quarter 1 year earlier, but 32% in the fourth quarter of that same year. Late 2022 experienced the first decline in real home prices in over a decade. Investor purchases remained a high share of total sales because owner-occupant home buying fell just as sharply. Investors bought 26% of single-family homes in the fourth quarter of 2022, just shy of the record high 28% share recorded in early 2022, and well above the 16% share averaged in the 3 years immediately preceding the pandemic. According to CoreLogic, purchases of single-family homes by investors who simultaneously own 3 or more properties within the past 10 years declined by 25% year over year in the fourth quarter of 2022. In terms of housing supply, the premise of the JCHS study is based on the fact that there is a significantly chronic housing shortage, particularly for affordable housing, but multifamily housing production remains strong. Housing production declined modestly in 2022, driven by a sharp slowdown in single-family home building. There is a significant housing shortage, and affordable housing programs pale in comparison to the need for housing. Despite historically low levels of supply, higher interest rates have sparked a slowdown in the construction of new single-family homes. At 43 years of age, the median home in 2021 was the oldest it has ever been, up from 27 in 1991. The number of newly started housing units fell from 1.6 million in 2021 to 1.55 million in 2022, a small but significant 3% decline in the context of the nation's housing shortfall. Similarly, the number of permitted units declined 4.1% to 1.67 million in 2022. Rising cost of land, labor, and building materials has emerged as a key challenge for home builders and developers and impedes efforts to build the amount and variety of housing needed. The Federal Reserve Bank of Philadelphia estimates that the nation's housing stock needs repairs amounting to $149 billion, including $57 billion for homes occupied by households with lower incomes. Further jeopardizing homes is the increasing damage from climate-related disasters. Additional lower-cost housing needs to be built, but expanding development will require zoning reform to support a broader range of housing types and investments in off-site construction methods that could reduce development costs. In contrast to single-family home building, multifamily construction continued to rise in 2022 to the highest number since the mid-1980s. The number of multifamily starts rose 15.5% from an already high 474,000 units in 2021 to 547,000 units in 2022, the highest level since 1986. The seasonally adjusted rate of multifamily starts remained strong throughout the year, averaging 540,000 to 550,000 units in both the first and second halves of the year. With this overview of the pertinent housing supply information in mind, let me now turn your attention to our analysis of the Federal Reserve's monetary policy. The general theme of this section is that the Fed has set forth hawkish monetary policy via higher interest rates to curb inflation. The outstanding questions raised by Adkins Capital Management are: why did the Fed cut the reserve requirement to 0% in 2020, and when will it be raised? During the second quarter of this year, the Federal Reserve continued to convey that it is primarily concerned about reducing rampant inflation levels in the U.S. by implementing hawkish monetary policy. Accordingly, the Federal Reserve raised the target range for the federal funds rate from 4.75% and 5% in March to a range of 5% and 5.25% in May, and then held that level for the remainder of the quarter. To follow suit, the national average mortgage loan interest rate for a 30-year fully amortized fixed-rate loan began the quarter at 6.93% and ended the quarter at 7.625%. The national average mortgage loan interest rate for a 30-year fully amortized fixed-rate loan reached an all-time low of 2.67% on December 17, 2020, and the all-time high of 18.63% in October of 1981. In light of the Fed's policy position, it is perplexing to understand why a major monetary policy feature that is at the discretion of the Federal Reserve is not being utilized or even discussed in order to combat inflation in the U.S. For more than a decade, prior to March 26, 2020, the reserve requirement was fixed at 10%. At that level, the amount of money in circulation would have been curtailed to a level that would have helped mitigate inflation. Moreover, such policy strengthened the financial solvency of the U.S. banking system. However, on March 26, 2020, the Federal Reserve lowered the reserve requirement from 10% to 0% for all depository institutions. This policy provision dramatically raised the amount of money available to be in circulation, which in turn helped exacerbate inflation. To make matters worse, such policy weakened the solvency of the U.S. banking system. With that in mind, it would be prudent monetary policy to raise the reserve requirement back to 10% in order to help curtail inflation, examine its impact on the inflation level, and if still necessary, continue raising the reserve requirement until inflation is brought down to an acceptable level. Such a position would also allow the Fed to implement a more dovish monetary policy in terms of interest rates, which in turn would help bolster the U.S. housing market, help the GSEs exit conservatorship, and strengthen the financial integrity of the banking system. Finally, it is important to note that it is prudent policy to have a reserve requirement of at least 10%, because it will mitigate the need for the Federal Reserve stress test, which is inadequate for measuring the stability of the U.S. banking system in an environment of rising inflation, rising interest rates, and recession. Simply explained, without a material reserve requirement level, the impact of a prolonged inverted yield curve could wreak havoc on the U.S. banking system, because the banking system's business model does not work in an environment where it has to borrow money on a short term basis at high interest rates and lend money on a longer term basis at lower interest rates. Now that I have provided an overview of the events and trends that have taken place in the residential housing environment for the quarter, let me turn your attention to the proprietary finance based analytical methodology and cloud based residential real estate analysis software application that you can use in order to provide an assessment of the price level of homes in your community, as well as for specific home purchase opportunities. The Adkins Residential Home Valuation Analyzer is an internet based software application that analyzes the relationship between the median home price level for a city and the median household income level for the city. With this information, the software application takes into account the most recent month ending national average mortgage loan interest rate for a 30-year fully amortized fixed rate mortgage loan and the assumption that no more than 28% of pre tax household income should be spent by homeowners in order to repay the principal and interest costs for their mortgage loan. By utilizing this information, the Adkins Residential Home Valuation Analyzer can accurately assess the price level of homes in your city. From the first analytical perspective, the Adkins Residential Home Valuation Analyzer determines the level of underpricing or overpricing of homes in your city by calculating the mortgage loan interest rate that justifies the price level of homes in your city. With this information, the justified mortgage loan interest rate is compared against the national average mortgage loan interest rate in order to accurately quantify and assess the level of underpricing or overpricing of homes in your city. From the second analytical perspective, the Adkins Residential Home Valuation Analyzer calculates the percentage of household income that would have to be spent by the people that live in your city in order to justify the price level of homes in your city. With this information, the justified percentage of household income amount is compared against the traditionally accepted household income amount of 28% in order to accurately quantify and assess the level of underpricing or overpricing of homes in your city. By utilizing the Adkins Residential Home Valuation Analyzer, you can determine the level of underpricing or overpricing of homes in your community, as well as the magnitude of underpricing or overpricing of a specific home that you are considering to purchase. This in turn will help you make a prudent home purchase decision. For more information about our finance-based analytical methodology and the use of the Adkins Residential Home Valuation Analyzer, please review our finance-based analytical methodology report on the Adkins Capital Management website and watch the wealth of movie presentations that provide an overview of how the Adkins Residential Home Valuation Analyzer is utilized. Based upon Adkins Capital Management's home price level analytical methodology, this section of our analysis pertains to Adkins Capital Management's housing analysis. The general theme of this section is that home price levels are overpriced in 54 cities among the Adkins 60 City Home Price Index. With this overview in mind, let us now focus on the assessment of the price level of homes across the country. Based upon the justified percentage of household income amount, 54 cities that make up the Adkins 60 City Home Price Index were classified as overpriced for the second quarter of 2023. Honolulu, Los Angeles, San Diego, San Francisco, and Portland, Maine were identified as the 5 most overpriced cities in the index. It is important to note that San Diego and San Francisco had the same justified percentage of household income amount. In terms of a relative price level analysis, it is not possible to justify the home price level for the top 5 overpriced cities by reducing the 30-year fixed rate mortgage loan interest rate from 7.625% to 0%. Therefore, in order to classify the homes in the top 5 overpriced cities as underpriced, it would need to be deemed prudent by prospective homebuyers to spend more than the respective justified percentage of household income amounts. In order to justify the median home price level for each city, the median required household income level will need to increase to a level within the respective range of $213,336 and $423,645. Based on the median household income level, the quarter-ending national average mortgage loan interest rate, and the assumption that no more than 28% of pre-tax household income should be spent in order to repay the principal and interest costs of a mortgage loan, the justified home price level for the top 5 overpriced cities fell within the respective range of $218,467 and $417,004. It is important to note that given the current interest rate environment, the justified home price level for the top 4 overpriced cities is lower than their required median household income level. Moreover, the lack of congruence between the median home price level and the justified home price level falls within the range of 3.36 times to 3.79 times, which is likely due to the preponderance of homes being owned by people that do not earn their income in the city in which the homes are located. Prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the level of overpricing of homes in their community. On the other side of the spectrum, based upon the justified percentage of household income amount, 6 cities that make up the Adkins 60 City Home Price Index were classified as underpriced for the second quarter of 2023. Detroit, Cleveland, Jackson, Des Moines, and Huntington were identified as the top 5 most underpriced cities in the index. It is important to note that Birmingham, Alabama was identified as the 6th most underpriced city in the index because its justified percentage of household income amount matched Des Moines, but its justified mortgage loan interest rate was lower at 6.95%. In order to classify homes in the top 5 underpriced cities as overpriced, the national average mortgage loan interest rate would have to increase from 7.625% to more than the respective justified mortgage loan interest rate amount for each city, which fell within the range of 7.2% and 19.7%. Or it would have to be deemed imprudent by prospective home buyers to spend as much as the respective justified percentage of household income amount for each city in order to repay the costs of a mortgage loan. Given the recent events that have transpired in the residential housing market, and taking into account the fact that buying a home will likely be the largest single financial transaction that prospective homebuyers will ever make, and the bulk of their net worth will likely be tied up in their home, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to analyze residential real estate from 5 financial perspectives. First, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the level of underpricing or overpricing of homes in their community. Second, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the largest amount of money they should spend in order to purchase a home. Third, prospective home buyers should use the Adkins Residential Home Valuation Analyzer in order to assess the amount of money they would need to earn on an annual basis in order to be able to afford to purchase a specific home. Fourth, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess total home ownership costs expressed as a percentage of household income. And fifth, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess how much a home would need to appreciate in value each year in order to offset the costs associated with owning the home. By assessing residential real estate in this manner, prospective homebuyers will be able to make a prudent home purchase decision. For more information about the Adkins 60 City Home Price Index, to watch our catalog of residential housing movie presentations, or to subscribe to use the Adkins Residential Home Valuation Analyzer, please visit the Adkins Capital Management website at residentialrealestateanalysis.com. This is Troy Adkins, saying thank you for taking the time to listen to this presentation.